Right, so there has been a very smart recovery on all the key indices from the day's low. Almost 450 points is what Bank Nifty has actually rebounded by, led by PSU banks. So Nifty and Sensex may not offer you a lot of relief, but banks are coming back, and banks is the area of focus, which we will start the interaction today with Mrinal Singh of InCred CIO over there, of course, is joining us today. Mrinal, afternoon, thanks for your time, joining us on Newsroom. Mrinal, I was just reading a report this morning that industrial loans, corporate loans, have crossed the 29 lakh crore mark once again. If the producer can just put out those data points on the screen. And that is important because we saw in the third quarter a lot of corporate banks, a lot of PSU ones have come back, and they are reporting not only good data but commentary that corporate inquiries have come back, and hence the loan credit growth is looking upwards yet again. Just taking reference from that, what are your thoughts on credit growth and role of banking sector now from here on in overall market performance?
So it's a very pertinent data, and I think a very strong indicator of economic activity, particularly in manufacturing side, getting picked up. So the credit growth data is the lead indicator that most analysts look for. The conversations around with be it the lenders, be it the borrowers in that space are very, very encouraging. So we are clearly seeing that the economy, or a section of corporate India in particular, has walked into what I would call the capex mode. And generally we've seen that this is the start of a long runway of an entire set of economic activity in the entire value chain that happens. So very strong indicator, I would say, Jay. And I think it's a very good thing for the economy.
Right. Mrinal, I was also going through the presentation of your presentation, and one of the points which caught my attention was the per capita income crossing the $2,000 mark now, and the estimate is that it may cross the $3,000 mark by 2025, give or take 6 months. But what does this really mean for categories? Our viewers would be doing the research. I wouldn't talk to you about stocks, but which are the categories which are likely to see good boost if indeed Indian per capita income reaches that threshold?
It is, in my view, the holy grail of growth. So IMF says our per capita income is something around $2,200. And by FY25, they estimate that we would cross 3,000, and by 30, they estimate we would cross $4,700 per capita. Now, the important point is that, 2000 to 3000 transition. We have had, this kind of transition in some phases in the last 50 years with a lot of economies. Now, interestingly, what we've seen that there is a very standard set of things that households spend upon when they go about seeing that income transition. And that includes, things like individual mobility, education, leisure, travel, entertainment, consumer durables, and things like those. So it will be no different in our economy. So this will be by far the 4 or 5 areas where Indian households will meaningfully, spend going ahead. The consumer behavior and patterns will be aligned to that. What changes maybe in 50s if an economy was transitioning from $2,000 per capita to $3,000, maybe entertainment meant Walkman or things like those, and maybe in the 90s it meant cable TV or something. What has changed now, it is maybe OTT now, maybe IPL is entertainment, is something else in entertainment, so only the underlying change, but the unmet need or incremental disposable incomes getting diverted into that consumer behavior is going to be no different in our economy, so no doubt about it. But it is also interesting to point out, that we are a 3 trillion economy as we speak, and, let's say even by IMF estimates, we'll be roughly in 8 years, let's say double the size. Now, 3 trillion becoming 6 trillion, now this is a very meaningful number. We have had very few instances in the last 50, 60 years where this kind of additional economic size has been created in economies. I can recall 2. One particularly was Japan in the 50s and 60s, and subsequently, and then China in the 90s particularly. So we are talking about another large economy adding 3 trillion worth of economic output, economic potential for a lot of goods and services businesses which I think is a historical thing from an economic perspective. A lot of activity, a lot of business will get generated, which is important. It's not important that India is going to double income in the next 8 years exactly or not. What is important is if it is early, it is 6 years. If it is not so early, it could be 9 years or 7 years. That's not the point. The point is, that we are clearly embarked. The economy is clearly embarked in that direction. The slope can be debated, but the trend and the direction is very, very clear now.
Fair point. The other thing which is a lingering worry in the mind and the market last few days is the way crude oil prices have shot up. The trigger could be geopolitical, the way FII flows are coming down, bond yields, etc. But then there is a thought coming in that even during periods of spike in inflation, historically, couple of months or even more than that, 4-5 months or maybe a year plus, even during phases of high inflation, growth has actually not been impacted a whole lot. And actually crude oil price spike is not that big a worry for Indian economy as sometimes it appears to be, because Indian IT exports are going up, the macros are very different. So just crude price hike in isolation should not be seen. What are your thoughts on that?
Excellent perspective. Every time crude reached such levels in the past, we had a chaos in the economy from the prospects of inflation, from the prospects of the government balance sheet, and then there were calls for subsidy and all kinds of oil price regimes that came into picture. At one point, we also had, I remember, oil bonds that were issued, and some refiners had to sell them at loss and all that. But what we have now, is an excellent state of affairs. By that I mean, that I think in the last 20 odd years, it's the first time we are seeing that our IT exports, which are in excess of $150 billion for this fiscal, are sufficient to actually provide for our energy imports, which is largely crude. So this hasn't happened in the past. Now that is the strength of the human capital the economy has produced, and that is very commendable in terms of the progress that we've made. It's no wonder that crude is almost lingering around 100, and we still don't have a big hue and cry, particularly from the economists and government policymakers. Now the reason primarily is because we are able to, after long many years and toil, we are able to, largely through our services export, able to fund our energy import. Now that's one. It is also interesting that in the meanwhile, the landscape of outlook for fossil fuels has meaningfully changed. There might be plenty of reasons why crude could be where it is, geopolitical and all that, but then the reality is that the long-term outlook for crude is not that great. It is unlikely that it will be able to sustain over here for a long period of time. Now that also means that it creates a third angle, which is a very important angle in my view. A higher price of fossil fuel or carbon emitting fuel basically creates the business case for green fuel or sustainable methods of energy generation and accelerates their adoption. So we've seen that last time we saw crude reach such levels and prices went that high, we saw the consumer behavior in particular move towards diesel. And we had a big uptake in diesel car sales in the 2012-13 era, if you remember, around that time zone. And then that was the transition that happened, although it created more issues with the government balance sheet because diesel was subsidized far more than petrol. But nevertheless, now in the era that we are today, where the future is clearly green, the source of energy generation would be more environmentally compliant. Higher fossil fuel prices only make those business cases more viable. In any case, we are able to fund our crude or energy imports through our IT exports. And interestingly, the long-term outlook, at least for fossil fuels prices, are not something even close to what it is now. Now, what it does is in the near term push up inflation numbers because crude is an imported inflation, more or less. And it also has an effect on, crude derivatives, which are in terms of chemicals or petroleum products of various order. I think that's something that is a botheration, particularly for individual businesses or sectors. But I think that's part of the cycle. Mostly it will, in some period of time, normalize, and things should be, at least the outlook could normalize, and things could normalize on that front as well.
Right. Mrinal, the other point I would like your thoughts on is that the quarter gone by, I mean, just yesterday, look at Ambuja, the margins came under pressure. Host of companies saw margins coming under pressure. Some were able to tackle them, some were not able to tackle them, and hence saw the brunt in the markets as well. But what are your thoughts on the universe of companies you track and have in your portfolio? Is the worst of margin pressure done in third quarter, or margin pressure could remain an issue for corporate India even in the fourth quarter?
So the most talked about question in the investment community actually as of now. So interestingly, when we saw for the last 3-4 months in particular, we had the WPI running in double digits. Now that's the wholesale price index, and the CPI was running between 4 and 6. Now that was a sign that the wholesale prices are kind of up, but consumer prices are not being pushed. So it was very apparent that we are going to run into Q3 fiscal 22 in a form where there would be a margin pressure largely on the corporate. We also need to keep in mind, corporate India in the last 2 years, that is the Corona time zone, has had a very beginning Corona in 2020. Corporate India was very aggressive in cutting costs. So we were trending on the higher side of aggregate margins for corporate India. I think some bit of normalization was on the anvil, but it has also happened that the steep raw material cost pressures have compressed margins. What is important to see going ahead is how many sectors and businesses are able to pass on those incremental costs. Now that's a function of growth. I think if we are seeing some sectors continuing to report compressed margins to whatever degree that has been reported, that's a sign that they are not confident if they'll be able to push price, the demand will sustain or not. And they would rather sustain demand with a little lower profit and see if they can do price increases later. There would be some businesses which will be able to actually, push up price a little without impacting the demand, what is typically called demand elasticity in economics. It is in terms of margin expectation, I would say, it's too early to say that margins are going to meaningfully move up, because the mean was never what we saw in the last calendar year. That was not the mean. It was actually on the higher side of trend in terms of corporate India's margins, I think. But can margins normalize upwards from here on? The answer is yes, I think, and that's largely a function of how raw material inflation plays out. I think we are walking into a time zone where corona-related disruptions in global economy are subsiding. There are more capacities coming on stream, so the supply chain related disruptions should normalize, and we should have at least some relief on shortages of raw materials, which is, in my view, a primary reason why we have seen raw material inflation rather than anything else. The demand has recovered to the pre-COVID levels in most sectors, but it has not shot up to a level wherein you would say that there is sheer shortage and prices need to go up. I think there is more to do, or I would say more than 50% reason in my view would be attributed to lack of supplies, and which is where I think your earlier question of the companies getting into a capex mode is a sign that they can see that the demand will continue. It is going to, there is a long runway of demand, and we might as well expand capacity and create supplies, and that would be the right way to bring down inflation as well as create jobs and normalize margins as well.
Right. All right, Mrinal, always wonderful getting your inputs on the channel. Thanks very much for your time this afternoon as well. That was Mrinal of InCred talking about various elements of investing. Let's take a short break here. On the other side, we'll get you a big voice. Rakesh Jhunjhunwala will share his nuggets of industry and investing and the sectors he likes on the other side of the break. Don't go anywhere.